Welcome to Wealth Lab. Okay, so today we're looking at a genuinely fascinating paradox. Wall Street literally spends billions of dollars every single year trying to convince us that investing requires complex formulas, super expensive software, and the magical ability to pick the absolute perfect stock at the exact right moment. Yet the world's greatest stock picker himself, Warren Buffett, actively tells almost everyone not to pick stocks. Instead, he points to one specific, incredibly simple investment as the absolute best choice for most people.
Yeah, Warren Buffett famously recommends low-cost index funds over pretty much anything else. And he believes in this straightforward strategy so deeply that he actually left very specific instructions in his will for his own family's financial security. He stipulated that 90% of the cash left in trust for his wife be put directly into a very low-cost S&P 500 index fund. Not complex hedge funds run by his billionaire buddies, not a hand-picked portfolio of individual stocks, just a simple, steady index fund.
Now, have you ever felt like investing is kind of like a rigged game meant only for Wall Street experts? Or maybe, you think it's just way too complicated and risky for you to even try? Well, you are in the exact right place. We're going to break down this incredibly simple, risk-reducing strategy together. Here's our quick roadmap for today's explainer. First, what it actually is. Second, why it works. Third, the real numbers. And fourth, getting started. We're going to completely avoid dense financial jargon today, I promise. Okay, let's dive into this. Section 1, what it actually is. So to understand an index fund, you really just need to know what an index is. An index is simply a list of investments. The S&P 500, for example, that's just a list of 500 of the largest companies in the United States. Think Apple, Microsoft, Amazon, the whole shebang. An index fund, then, is an investment that simply buys a little bit of all the companies on that list. Think of it like buying a variety pack of cereal instead of betting your entire breakfast budget on just one single flavor. By owning a tiny slice of hundreds of companies all at once, you instantly spread out your risk, rather than betting your hard-earned cash on one single company's success or failure. And this brings us to a massive difference in the investing world: passive management versus active management. See, index funds are passive. They don't try to magically guess the future. They just follow a set list of rules. It's the ultimate set-and-forget strategy, bringing you peace of mind and, honestly, significantly lower stress. On the flip side, active management involves highly paid professionals who spend all day trying to pick winning stocks to beat the market. They're constantly trading, constantly stressing, and, most importantly, constantly charging you for their effort. But why exactly does this simple, passive strategy consistently beat those so-called experts? Well, that brings us to Section 2, why it works. And this brilliantly illustrates a key mathematical reality. The stock market is essentially a zero-sum game before costs. For every winning trade in the market, someone else has to take an equal loss. Because all investors collectively own the entire market, the average return of everyone together is exactly the market return. It forms a perfect bell curve right down the middle. You've got winners on one side, losers on the other, balancing each other out perfectly. Now, what's really interesting about this slide is what happens when we factor in the high costs of active management. The massive salaries, the expensive research teams, the constant trading fees, the entire curve shifts to the left. These active managers literally have to beat the market by a huge margin just to break even after taking their cut. So the math essentially guarantees that most of these highly paid active managers will inevitably underperform a simple, low-cost, set-and-forget index fund. The numbers behind this are absolutely staggering. 92%. That is the percentage of professional fund managers who underperformed the S&P 500 over the 20-year period from 2004 to 2024. Let that sink in. Despite all their fancy charts, extensive research, and 80-hour work weeks, trying to pick winning stocks fails for almost everyone. Spreading your risk across the whole market is what actually wins long-term. Let's look at an engaging real-world example to prove this math in Section 3, the real numbers. Back in 2008, Warren Buffett challenged the entire hedge fund industry to a $1 million bet. It's really the ultimate underdog story of simple versus complex. He wagered that a basic, low-cost S&P 500 index fund would beat a hand-picked portfolio of actively managed hedge funds over a 10-year period. And guess what? Only one firm, Protégé Partners, was brave enough to accept the challenge. Over that decade, this simple index fund earned a massive 126% return. Meanwhile, those complex, highly expensive hedge funds scraped by with an average return of just 36%. Simple passive investing completely crushed the expensive professionals. If you're finding this valuable, please subscribe to Wealth Lab and share this video with your friends and family. It really helps us grow. So, what does this all mean for your actual money? Historically, the S&P 500 has earned a compound annual growth rate of roughly 10%. Now, sure, the market goes up and down in the short term, but over decades, that average is incredibly powerful. To put that into perspective for you, if you simply invested $200 a month into an S&P 500 index fund, assuming that historical 10% average, your money would grow to over $400,000 in 30 years. Small, consistent investments grow massively over time. You definitely don't need to be rich to start, you just need to give it time. So, the crucial point is getting started, which brings us to Section 4, Getting Started. Here are the practical, beginner-friendly steps to open an account and start investing today. You can literally do this right from an app on your phone in about 5 minutes. Step 1, pick an account type. This could be a tax-advantaged retirement account like an IRA or 401k, or just a standard taxable brokerage account. Step 2, choose a broad market index fund, like one that tracks the S&P 500. Step 3, invest consistently. Set it to automatic if you can. And honestly, here's the absolute best part. Many brokerages now offer fractional shares. This means you don't need hundreds of dollars to buy a whole share. You can start investing right now, even with a very small amount of money, like $5 or $10 a week. So are you ready to stop trying to beat the market and start owning it? You really don't need to be a financial genius to build wealth. You just need patience, consistency, and a low-cost index fund. Thank you for joining us today. If you haven't already, don't forget to subscribe to Wealth Lab. We'll see you in the next one.